Hi everyone, Becca Hennessy here, and I'm very excited to visit with you, share some breaking news, and have the privilege to introduce you to a man who is extraordinary and quite unique, and is considered by many to be one of the top investment managers. His name is Dr. Paul Wendee. He holds a doctorate in business administration and finance and has spent the last 38 years obsessively studying, researching, investing, and teaching some of the most powerful investment strategies that bring higher returns and, most importantly, at a much lower risk. Dr. Wendee has dedicated his life studying, learning, teaching some of the most powerful and profitable investment strategies you'll find anywhere. He began his career early on in the research department of First Affiliated Securities and later moved into the due diligence departments of Anchor National Life and Anchor Financial Services. And from there, he became a portfolio manager with the famous Harris Bank Corp. Dr. Wendee clearly understands how important it is to do due diligence, and as an investment banker, has more than 38 years of experience with successful funds in the alternative markets ranging all the way from real estate to private equity. The reasons why Dr. Paul Wendee is so unique is his extreme passion along with his absolute transparency and his strong business acumen. This makes for a powerful combination. So it's easy to see how his passion for investments in all aspects has led to his doctorate of Business Administration and Finance. And the reason I'm so excited today is Dr. Wendee is here with me, sharing the fascinating news about his latest fund. And together, we're going to discover why his Double Alpha fund can be so powerful and at the same time be able to substantially reduce risk. So, Dr. Paul Wendee, thank you for joining me today.
Thank you, Becca.
You're a doctorate of finance and a professor. I want to invest in alternative investments. What is the best way for me to maximize my return while significantly reducing my risk?
Well, Becca, we have to first step back for a moment and look at an entire portfolio, an investment portfolio. And traditionally, investment portfolios would be stocks and bonds. They might have some, what we call alternative assets, but for the most part, they were stocks and bonds. A couple of decades ago, about 20 years or plus, people started considering putting other types of investments in portfolios. And by the way, alternative investments is a catch-all term for a lot of different things. But alternative investments are oftentimes a lot of real estate investments. Private equity has been something that people have added into portfolios, the alternative investments. So the alternative investment space is really anything that's not a traditional stock and bond for the most part. When you are looking, if you have your regular investment portfolio and you're looking to increase the returns and also reduce the risk of the portfolio, that's where you think about adding alternative investments.
What is the best way for me to reduce my risk in the alternative investment arena?
Well, Becca, so again, we want to first of all look at reducing the risk in the portfolio. So to do that, we add alternative investments. Now, in the alternative investment arena, the best way for us to reduce risk is to diversify our alternative investments. And there's actually two parts to that diversification. Most people think of diversifying their alternative investment portfolio just by having X number of alternative investments, and if something goes wrong, one doesn't perform as well as it should, or even doesn't perform well at all. Say you have 15 alternative investments, one doesn't do well, you still have 14. So that is one area of diversification and risk reduction in the alternative space. The other thing that most people aren't aware, I think a lot of professional finance people and finance professors and so forth understand this well, but the average person doesn't really understand this, is the fact that alternative investments and investments in general will tend to have a low correlation with each other. And it's that low correlation, or in some cases even no correlation or a negative correlation, that significantly reduces the risk in a portfolio.
So non-correlated investments are good?
Or low correlation.
Low correlation.
Yes, low to correlated or negatively correlated or non-correlated is good.
Okay, that reduces your risk.
Correct.
Even more.
Yeah. So Becca, let me show you how that works. Let's say that we have a two investment portfolio, and we're going to draw a line here, which is going to show us how this two asset portfolio might perform over time. And let's say that the two assets we have are Ford Motor Company and AutoZone. Okay, now this is just an example, just to kind of show you how this concept works. And so this line represents the fact that this two asset portfolio, both stocks over time are increasing in their returns or increasing in their value. And so, but at any different point in the economic cycle, they're going to be having different movements relative to the cycle.
Sure.
So in a strong economy, Ford Motor stock might be going up because people are buying new cars, all right? AutoZone, which makes aftermarket car parts, may be doing okay, but not so well, not as well as Ford, because people are buying new cars. They're not fixing up their old ones, all right? Now the economy turns a little bit. Okay, Ford Motor may not be doing so well, whereas AutoZone, now people have to fix their cars because they're not buying new ones. They're keeping their cars longer. And so AutoZone will go up. And you can kind of see how that pattern repeats throughout different economic cycles. Again, this is strictly assumptions, but in this case where we're making these assumptions, we're assuming that both companies are doing well and continue to grow over time. But you can see here what's happening in this two asset portfolio. Okay, you're really eliminating the variation in the portfolio because as one's going up, the other one's going down. This would be a case in this illustration. These two assets would be negatively correlated because when one goes up, the other one goes down. That doesn't oftentimes happens, but again, this is just to illustrate the point. Well, when you add alternative investments to a portfolio, they tend to have a low and in some cases, a negative correlation with other assets in the portfolio, so you get this same effect. So that's why we like to add alternative assets to a portfolio, and why we add a number of different alternative assets in a portfolio, so that because the alternative assets will not only be low or negatively correlated with stocks and bonds, but with each other as well.
How do you do your due diligence to find the investments that you invest in? Well,
we are, you mentioned earlier that my 38 years of being in this industry, and I really started out, a couple of years after I was a stockbroker with a regional firm out of Los Angeles called Bateman Eichler Hill Richards. It was one of the big regional firms. And then I started out with First Affiliated Securities, working in their research and due diligence departments. So since 1984, I've been getting experience with these asset classes and these and the sponsors of that provide these assets for us. And many of them are still around from when I first started in 1984. But that's a big part of my career was just in doing due diligence on these types of assets. And so I've got that kind of experience factor of having just done that for a long time, and knowing the sponsors. Many of the old ones are still with us. As new ones come in, again, we just have a lot of experience in analyzing these. And I think most importantly for our fund is we're part of a community of investment bankers that have been around, again, as long as I've been in the business, 38 years plus. And so when we're looking at these investments, now when I started out in 1984, every investment banking firm, and I worked for quite a number of them, would have their own due diligence departments.
Sure.
And so we would look at these these sponsors and their assets. Might be a real estate program, might be oil and gas, whatever the case. We would do our own due diligence. Over the years, some of the people like myself that were early on in the due diligence space, several of them broke off and formed their own firms, and we have relationships with those people today. So that's all they do that's what their firms do, is do due diligence, and they're part of our team.
That's incredible, and you have relationships with them.
We have relationships,
so
and so we outsource to these firms. So again, if you look at the Northwest Quadrant Opportunity Fund, our fund, a big part of our team are these due diligence firms, and when we meet several times a year in various parts of the country. When I say we, the investment bankers and the due diligence firms and funds like like ours and other types of funds, we are looking at these investments and then talking about them amongst ourselves, because there's a lot of experience and a lot of kind of brain power amongst the group.
Sure.
And so as we're talking to one of our colleagues or cohorts, we'll say, we're looking at this particular sponsor, does anyone have experience? And in many cases, they do. Sometimes it's been positive experience, sometimes negative.
Right. So by doing your extensive research with your massive Rolodex file and knowing the best fund manager, you're able to find 10 to 15 non-correlated investments that you believe are the best performers, right?
Well, yes, Becca, and actually it's many, many more than 10 to 15. Again, we've got 38 years of experience, and as you mentioned, we have a very extensive Rolodex, just because we've been around a long time doing this. And so there are many, many investments, most of which are very, very good. But with our team and our experience and our contacts, we're able to find at least 10 to 15. Frankly, that's the target that we have for the fund is 10 to 15 of the different managers and the asset classes that we like. So yes, you're correct. It's
ooh, that's great. So you actually have the ability to find 10 to 15 non-correlated
Correct.
investments and possibly even more.
Correct, and I don't, not just non-correlated, because to find absolute non-correlated, many of them are, but low correlation is good enough. So you can achieve the benefits of getting the higher returns with lower risk by just having low correlation. It doesn't have to be negative. In a perfect world, they would all be like the Ford and the AutoZone example I showed you, but low correlation is good enough.
So it looks to me that we can improve our risk-to-return ratio by a significant factor.
Yeah, and Becca, that's what we're looking for in finance, is to increase the return, lower the risk, and that's what this is all about. This is the what we achieve, what we're attempting to achieve with our fund, and all the background of finance and investments that we have, and just the years and years of experience we've been doing this. So absolutely correct. We that's what we're shooting for, improving the risk-return ratio.
So by using your diversification model, it tells you what investments you should be going after, right?
Yeah. So yes, Becca. With our risk return model, we have a pretty good understanding of all of these asset classes. The correlation that they have with other assets in the portfolio and with each other. And when we're building a portfolio for the fund, okay, because our fund of funds is investing in other funds. Well, those other funds we invest in, one of the things that we're looking for is that low correlation, to whatever extent we can achieve that.
Sure.
When we're selecting investments. And then when we have the fund, or when another fund manager adds our fund into their portfolio, then that the goal there is to reduce the risk of that other portfolio's risk altogether.
And again, your 38 years of experience and knowing these people and building up an incredible Rolodex file, is that why you travel also, so that you can keep the relationships going and so forth?
Absolutely. We're traveling all the time. We meet several times a year in various parts of the country with several different industry organizations, where that's all we do is we go and look at these types of investments. And then we go and meet with the sponsors of these investments. So we're all the time traveling and looking at investments and talking to them on the phone, and they come and visit us. So that's what we do.
Well, that's wonderful. Do you ever speak at any of these conferences that you go to?
I do. I speak at quite a few conferences, and quite often moderate the panels. And so, that the conferences are always a good way to keep up on what's happening in the industry. And again, when we go to the conferences, we're being approached by many of these sponsors, and so we get to develop a relationship with them, get a real close look at what they're doing. Use our network of outside due diligence firms to really dig deep, into the weeds, if you will, to understand what these, how these investments are doing, and talk to our colleagues. Again, there's so much benefit in having our colleagues that have had experience with these sponsors telling us what their experience has been, good and bad.
Sure. So, how many people are always trying to find out Dr. Paul Wendee's secret sauce?
Boy, let me think about that one.
Okay. So